I'm Michael Fox, and this is the Prospector Podcast. And I have joining me returning guest Mike McGlone, the Chief Commodity Strategist with Bloomberg Intelligence. Welcome, Mike.
Thank you, Michael. It's good to be back, and thanks for having me.
Yeah, whenever we manage to sit down to these, there's always interesting things for us to talk about. I was planning to have you on because copper had been maintaining some high prices when we've all been expecting it to reverse. And lo and behold, this week, President Trump comes out and slams down hard on a 50% tariff on copper imports into the United States. So I guess that's what we're going to be talking about now.
Well, it's quite impressive what's happening now is Mr. Trump's becoming emboldened to accelerate his desire to increase tariffs with the record-setting U.S. stock market. So there's a unique bent there.
Yeah, no doubt. Now, was copper telegraphing that going into that decision, because the prices, were remaining high when all the indicators should have been suggesting that copper should have been reversing and retreating in price. So we always say that it's a doctor in economics, and it's telling us something. And you and I had talked about this a little bit earlier in the year, and we really weren't certain what copper was telling us. Perhaps was it this?
Well, apparently, yes. Obviously, with the benefit of hindsight, we did see, the administration more favorable to 50% tariffs on steel and aluminum, and just carried it over the copper. So at least it's consistent across the board. What's unique about copper this year, it's had a significant trading environment. It's already had volatility is like the highest in about a decade. We started out around $4 per pound. We spiked up to $5.37, an all-time new high. And then when Mr. Trump put in his 90-day reprieve, we back and said he was just exploring tariffs and copper, back down to $4. That was really quick, back up to $5. Now we just put in a new high, $5.90. As we speak on Friday, July 11th, it's basically $5.60, about 30% above the London premium. This stuff has never happened, but there's obviously things. This shows you, I think, the significance, the unprecedented status of these tariffs. But what's happening is what we mentioned pre-show is now it's the only reason that Mr. Trump pulled back on his potential tariffs, which, by the way, he'd been speaking about for decades, and this was completely laid out in the book No Trade is Free by Robert Lighthizer. The only reason he pulled back on that was when, after the stock market dropped about 20% in April, he said, we're at 90 days delay. But now they're at record highs. He's hitting tariffs on everybody and everything as much as possible, particularly copper, obviously metals. Brazil now, even though Brazil runs U.S. runs a net export surplus with Brazil in terms of goods and services. But to me, this is what's happening now. It's a unique situation where the president's being emboldened to enhance his economic strategy based on the stock market price, which I think is quite this potentially by the end of the year, we might be telling a story, hopefully not, similar to we did in 2008. So I put down the narrative I put and really figure out here is, and the analogy I'm putting here is in 2008, when the U.S. price of gasoline, a gallon of gasoline jumped above $8 a gallon for the first time. That was a signal to sell everything. That was a signal that this was going to be a problem. It shut off consumer spending. And then by the end of the year, we saw what happened. Everything collapsed. I think copper now is potentially has similar inklings. I hope not, because it's spiking in the U.S. and dropping in the rest of the world. I just overlay copper with what's happening in China. The price it trades on the LME, which is close to right now, as we speak, $9,600 a ton. In the meantime, the equivalent price in the U.S. is around $12,000 a ton, but that price in the rest of the world is declining with Chinese bond yields, with PPI in China, Producer Price Index, it just came out negative 3.6%. Severe deflationary forces in China and potentially in the rest of the world facing tariffs. So this disparity is at some point, it's not going to last forever. You've seen major accumulation of copper in the U.S. It's just a question of when it goes back to parity. The question is, does the overall price of copper head lower? And I think that's the risk. Now, obviously, it spiked a lot this year. I didn't think it'd go this high, but we do have extraordinary events driving it.
Yeah, I think if you and I had sat down in January and said Trump tariffing copper 50%, I don't think it had been on either one of ours bingo cards as we were looking at that. But let's take a look at that oil situation in 2008. And I agree that that was probably a very strong signal, but in my mind, oil is different than what copper is. Oil is ubiquitous. It goes through literally every portion of the economy, from transportation to you filling up your car at the gas pump, etc. Where copper, yeah, it's ubiquitous in that it goes through a lot of different products, a lot of things to do with electrification, construction, and things of that nature. But it's in my mind, it would seem to affect the end consumer indirectly rather
Right.
than directly as what oil price would.
Oh, completely. You nailed that completely. Significant. It's not in your face. The most in your face economic indicator, and particularly in most of our countries, is the price of gasoline. Because every place you go, every time you see it everywhere, particularly those of us who are subject to automobiles in suburbs and things. Copper's, as you point out, it's less significant, certainly less in your face, but it's much more of an inherent economic, the economic indicator, as you point out, the metal with the PhD in economics. And the key thing to remember is these significant trends towards electrification means copper is becoming more significant every day, most notably much more than it was in 2008 when spiking oil helped tilt the world towards a global recession, and particularly in this country. So I'm just pointing that out. And there's just these certain trends in electrification make sense that copper should continue to outperform crude oil. I've been enjoying pointing out that forever, that to me, the best performing commodity should remain metals index. As part of the Bloomberg, we created the Bloomberg's All Metals Index. It's one of the best performing indices over time in all commodities, partly because you don't have issues with contango backwardation, very little. Metals are, very easy to store, and they're certainly it's a great combination, I think, when you put industrials and precious together. And then you look at all the precious metals, there's gold, and then all the other precious metals are actually industrial metals, silver, platinum, and palladium. But copper in this case is obviously front and center. It's just that disparity. So I will be publishing on Monday, July 14th, that my latest outlook and what I think is happening with copper. And I'm just comparing it to China. And my key quote is copper sustainable above $10,000 a ton? I think it's very unlikely, particularly with crude oil collapsing, not so much collapsing, but declining. Chinese government bond yields heading lower, PPI in China at negative 3.6%. And here's the thing that's really significant to me, I find, is what's happening in Chinese money supply. Now, we've known this for a while. Chinese money supply is ballooning at $45 trillion. That's up exponentially from where the U.S. That's double where the U.S. In fact, it crossed the U.S. in 2009 on the Great Financial Crisis. So what's happening in China is, I think, akin to what happened in Japan almost 30 years ago. They're doing everything they can to avoid severe deflationary forces. And copper's in the center of that. Their demand pull, their imports of crude oil are about the same now as they were in 2021. That's stalled. That's the first time in decades that imports of crude oil have stalled. But what's happening, as we see, is that transmogrification towards electrified economy. You see that in automobile sales. 50% of sales in China are automobiles. BYDs, I can't remember and pronounce some of the other companies, but and that's not just automobiles. It's almost all vehicles. So they're doing it fast, partly because they have that ability to create energy from technology. They're a massive production machine. They do not have the ability that we have in North America to extract energy from the ground, which we have an excess of. So to me, that's part of where I see, I'm pointing out that copper here at $10,000 or just below $10,000. I'm really worried it's going to just follow crude oil and tilt those deflationary dominoes as we see what's happening in China. And another part of it is iron ore. Iron ore just cannot stay above $100 a ton. It's another indication from China that there is just no organic demand pull forces. And as the U.S. tariffs kick in, it's probably not going to get any better for China.
If I understand you correctly, we have a push fee pull you situation happening where China is trying to pull the price of copper down and the U.S. is trying to push the price of copper up through tariffs. Am I reading that correctly?
Well, the U.S. has in the U.S., and the focus was just to increase domestic production, which means a key thing that's missing is smelting. Why does the U.S. export a large amount of scrap copper? Because it gets smelted in other countries, most notably China, where it's cheaper and less restrictive from an environmental standpoint. So we have to bring that back. It's just a matter of time it happens here. It's cost effective now. I mean, if there's profits involved, good old capitalists that we have in our countries will definitely swoop in, which the way they always do. But it's a unique situation. It's just by boosting that price and making it more difficult for the rest of the world is making it worse as they face those tariffs from the U.S. But right now, it's really a U.S. domestic situation with a spiking price of copper, which I'm sure that anybody who's producing copper in this country is salivating, would find a way to just profit into that. But the point is, I like to just point out, right now, that price of copper in terms of metric tons, it's up about 10% on the year. But the dollar index, that's 9,600. The dollar index down about 9% in the year. Okay, well, that makes sense. That's copper is very highly negatively correlated to the dollar. To me, it's the next thing that matters. I'm a strategist. Where's the next tilt? What's happening here? And I think it's much more likely dropped towards 8,000 metric tons and stay above 10,000 metric tons per metric ton. And the key thing that's holding it up right now is that U.S. stock market has to stay elevated because the whole world's depending on that. And that's getting in the macro. In the micro, closer to it's the disparity between U.S. and China and actually the London price that's most unique, but it's certainly, I don't think, is a good thing from a global economic standpoint.
So these tariffs, assuming, we don't have Taco Trump, they're supposed to kick in at some point down the road. Are we looking to see an inflated copper price in the U.S. up until the moment the tariffs actually kick in, and then you start to see the deflation that you're calling for?
Well, if it was that easy, as an ex-trader who used to have hair, we know how these things really usually work. The quote from John Licio, a former market strategist and journalist, pointed out that traders are dope sniffing dogs. They figured out they're well ahead of the game, and some of them were doing quite well by keeping that arb on long U.S. versus short LME and overweighting the U.S. And now it's a question of it's just a question of at what point, how much higher can it go before it reverts? Because virtually everybody knows it's just a matter of time that it has to revert and that spread will narrow. Question of when and how. Does it take a long time? Well, and it's one tweet at a time where we really have 50% tariffs, which I think is very silly to make that extreme. 15% seems to make more sense, give manufacturers a little bit of time. But Taco Trump, I think, is very disingenuous. I spent the last 3 decades of my life growing up, living in Connecticut and working in Wall Street, New York. And one thing I've learned about Mr. Trump, he is not a chicken. This guy is a badass. He is just the most blatant human beings on the planet, and he knows how to negotiate. And I risk the rest of the world that tries to negotiate with him. And I just learned to bow in his general direction and see what does this mean for markets. That's all that matters. And so right now, I think this means that this spike in copper at these levels, virtually everybody knows this is what happens. Like when palladium or platinum spiked up in 2004 and bought way too much. We all know what happens in this environment. It's a question of time that it reverts, and it can revert easily 50% in a heartbeat. The question is, certainly if we get a little bit of a recession in the U.S., which is way overdue, and with nothing like tariffs to push back on the earnings and create that little problem in recession, which would be in the back of a weaker stock market. So to me, it's just this is a collapse waiting to happen, and putting on long positions in U.S.-based copper now is very risky. If anybody's going to do that, it'd be considering copper in London, which is equivalent price around $4.38 compared to the U.S. at $5.60.
Which, if you take a look at the math, that's reflecting what the price in the U.S. would be delivered with a tariff almost. So, those types of things, kind of make some sense there. So let's take a look then at copper as it's an indicator. Normally copper would indicate that there's a recession on the way, and should be, reversing down, and the prices have remained high this year. So are the other recessionary indicators, are they out to lunch and copper's right? Or has copper been tricked into believing something else by the tariffs and the tariff threats over the course of the year?
Yeah, so that's the number one question that matters. As a strategist, I will just stick my neck out and point out my view. I think this is a pretty significant feint. By the time we get to the end of the year, it will look more, I think, unfortunately, more like a situation that happened in 2008 when commodities spiked in July. That's the quiet time of year, and then by the end of the year, they were collapsing. Crude oil is already doing that. Corn, soybeans, and wheat are already doing that because of massive excess supply. And copper is the main outlier. Now that it's making it as difficult as possible, but here's the significance. It has to stay elevated, or the whole commodity plant complex is, I think, just basically going to potentially do what a normal commodity price does after it spikes like it did in 2022. It takes a long time to find that low price cure. So I think this is what the risk is by the end of the year. So here's some prerequisites. First of all, if the copper stay elevated, number one thing, I think bottom line is obviously the tariffs in the U.S. have to stay in. But in terms of the macro, Chinese economy has to stay strong, which is already weakening. We see that in PPI collapsing, and the rest of the world pushing back on their chief exports that they can no longer export to the U.S. And the number one elephant in the room is the U.S. stock market has to stay elevated. I say that, Michael, because right now, at some point, when you get to 2.2 times GDP, it's all that matters. So when people say, oh, the market's great, everything looks fine, look at the economy, looks fine, like, yeah, great. It's got to look fine because the wealth creation effect in this economy, in this country, it's 2.2 times GDP, which is the highest since 1929. And the most recent example is 1989 in Japan. I started in the business in 1988 covering Japanese clients. And yes, maybe I'm jaded. I remember the Q-breathe then. To me, that's the number one thing that matters. So here's the way I see it. The U.S. stock market total return up on the year is about almost 8%, looking at 7%, looking at the S&P 500. Most people expected, their analysts was looking for 10% this year. So right now we're on a 15% or so pace if it continues. That would be wonderful. That's great. But what does that do? It keeps the Fed easing out of the picture, and it keeps Trump tariffs emboldened. Just imagine a year if it ends up down 2% or maybe even down or up 2%, down 2%. That would be a significant shift. And what would that be? Normal reversion. So to me, that's the big trade. That's the big potential optionality that I see in markets, that I see from declining crude oil and record-setting gold. And it's July. Remember, this is the time of year everything. The S&P 500's never gone down in July. It's the last time it's gone down in July was 2014. So it's the time of year you see those little extremes, i.e., 2008. But by the end of the year, the risk is. So my call is we'll see a little bit of reversion. We'll see that potential risk towards recession. We'll see a decline in risk assets. And copper would be a number one thing to suffer. So here's the bottom line. To stay strong, number one, copper has to have those tariffs, and it has to have a U.S. strong stock market. At these levels, the optionality is a little bit of reversion. And you get at least 6 months, well, 5 months.
So what's more important to the copper price, the tariffs or the stock market remaining high?
Well, to macro combined copper price in the rest of the world, its number one thing right now is the U.S. stock market. To almost everything is a U.S. stock market. For consumer spending in the U.S., the whole entire economy has not been as dependent on the U.S. stock market for 100 years because of the wealth effect. You know who gets that? The Federal Reserve gets it. They just don't say it. You can't ease anymore when you have, when the party's blasting off like this, is when you're supposed to take the fun punch bowl away, not add to it. So to me, but in the U.S., obviously, the only reason that U.S. copper is almost 30% above copper in London is because of tariffs.
Okay. So let's take a look at the last question I had in regards to all of this. And I see your point about the copper prices going into decline. So a normal decline in copper prices would take it generally down to around the $3 a pound mark. With the tariffs being at 50% in the United States, are we looking at a new floor at 450 rather than at 3? Or can, the cure for high prices is high prices?
Yeah.
Can it take, and even in spite of the tariffs, drive that copper price down below that level?
Oh, sure, absolutely. That's the key effect. Did you always remember? And that's so important. Commodities, they're becoming more elastic every day, and even some of the traditionally inelastic commodities. Copper is one of the most significant inelastic commodities because you just can't bring on that supply instant like you can in corn. You can bring that supply in 12 months almost always. So that's a key thing. So right now, the equivalent price for copper, if we didn't have tariffs, it'd be $4.40. Our model, we have my colleague David Zong in New York has a model. He's a very smart guy, created a model. He shows copper fair value in this country is around 450. So if tariffs come off for some reason, copper drops instantly to that level. What happens in London copper? I mean, this is why it's so unique. But the bottom line is, yes, maybe 4 is the new 3 in U.S. copper, but that's a question of how long this lasts. It's just a matter of time this supply comes on and we revert back to a normal cycle. And then we all know what humans do. When we get an opportunity, we create more with less every day. Why is the price of crude oil right now at $68 a barrel in the U.S. after peaking at 147 in 2008 and then 130 in 2022? Because it incentivizes all that supply, and now we have this major shift in the world to not use crude oil. I mean, all this incentive for electric vehicles and substitution. I mean, it's a big debate in this country if we can just bring on more renewable and biofuels because grain prices are collapsing and we have massive supply. So it's the key thing that I think I really enjoyed writing about in 2022 when Russia invaded Ukraine. That just added fuel to a pre-existing trend that I learned about from a great Canadian named Jeff Booth, who wrote The Price of Tomorrow, about technology moving so fast. And I hear this every time I'm in commodities, how we can just create more with less every day, and particularly when you reduce regulation in things like metals, like Mr. Trump just did. So I think the market's underestimating how quickly we can come on this supply and how potentially you might reduce demand. And find substitutes when you get prices like this. It's just don't underestimate human ingenuity when you do this. So I'm looking at it as normal and since the lesson you learn as a commodity person, it always helps to be contrarian in spikes and plunges because those usually just set up for the autocorrelation that's famous. And copper, every time it's got above $10,000 a ton in London since 2011, it's an average drop, 30, 40%. Has that changed?
That's a good question. And that's one of the things I like talking to you about because we start on a topic and then you bring up something that is related to the topic, but it'll go a little off the conversation. And you talked about substitution, electric cars versus gas cars, more electrification in order to supply that demand. Are these copper tariffs and an inflated copper price, is that going to slow the conversion and the changeover between gas and electric vehicles and the conversion to needing more electrical power in the United States?
Oh, absolutely. The price is one of the most number one factors in commodities. When we talk about supply and demand, usually they're somewhat past tense and they're priced in already in the price. But what you just mentioned has been the key focus I've had speaking with clients and running money since I first started in the business in 1988. Was everybody can read the Wall Street Journal and read that used to be read the Wall Street Journal. Now we get so much things electronic. We all have so much information. My job as a strategist always is to see what everybody's pricing in, see what they're reading and looking in, and trying to define what they're not expecting and reading and look at something different. So that's my always focus is find something new and different that you might not be aware of. But that's a key factor. Remember, Mr. Trump has already pushed back significantly on this push from the Biden administration and the previous Obama administration to accelerate the process of electrification. Now, I admit I took advantage of that. I own an electric car. It's 11 years old. I bought that on a subsidy, and I added solar panels to my house. I did that with a subsidy. Thank you very much. But I had to do it partly because it's my job to understand this technology, and the technology is overwhelming. It's that lack of moving parts in the solar I have in my home, and it's the lack of moving parts in an electric vehicle. All we have to do is get this storage and the capacity in batteries improved, and it's just a matter of time. It just makes internal combustion vehicles look like horse and buggy, just happening rapidly. So to me, that's so important. But now we have a Trump administration that's pushing back on that process that was being pushed ahead by government. He's pushing back a little bit inorganically. Now it's the organic forces that will matter. So, that's fine. Harnessing energy is the essence of the human condition, and drill at will means some more focus on petroleum in this country versus renewables. So, okay, how long does that last? Mr. Trump's going to be gone in 3.5 years. if there's that same mantra will mean we probably have to avoid a recession that we're way overdue. But again, one thing that remember here is just opening the macro big picture. Mr. Trump might go down in history as ending up on Mount Rushmore, or he might go down in history as similar bad timing as Herbert Hoover, because Herbert Hoover was elected in 1928 when the U.S. stock market, the last time it was at a similar level versus GDP. Just a little reversion is a problem. But copper's right in the middle there. He's making it expensive with tariffs. And bottom line, we have to remember is copper's up because of U.S. tariffs. What do U.S. tariffs do to earnings? My colleague Gina Martin Adams, our equity strategist, points out about 40 to 45% of S&P earnings are related to imports. And they just added a big tax on those imports, which means earnings are going to get hit. Costs for consumers are going to go up, which means it's a similar double whammy. Yet the market has not figured it out yet and thinks this is a wonderful, exciting environment. So copper's in the middle. And just a question. That's why I always keep thinking for this year, I'm really concerned that gold is going to be the best performer. And the thing is, it already performed so well. I'm just afraid where that's going to keep going, and I'm concerned. No one wants the rock to beat stocks, but the fact that it is means it might continue.
Yeah, well, no shortage of things for us to talk about, Mike, and I'm sure our next conversation will be about something else and tariffs, just the way things are going. If people want to follow your musings, Mike, how do they best do so?
On your show, thank you for having me. Once in a while, I'm on Bloomberg Terminal, on Bloomberg TV. Once in a while, I love being on Bloomberg in Canada. Canadians just love commodities, obviously I do, so that works out well. Plus, being from Chicago, I kind of feel I'd love to feel very close to Canadians, similar weather. And so on LinkedIn at Mike McGlone 11 or X, I'm sorry, and on Twitter, Mike McGlone Senior Commodity Strategist.
Wonderful. Thanks for your time to discuss this week's news. And I'm sure we're going to be back on in the coming weeks talking about something else.
Thanks, Mike. Thanks for having me. Looking forward to our next conversation and see how things have changed.
You bet. Thank you. The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.